Finally back after about 2 months. We've had a lot go on. I've had some personal issues I've had to take care of, and it's been a busy time in general, so I haven't been able to stream for a bit, but there's a lot to cover. We got the E-mini futures. It's been open for, about an hour now? It opened up, crashed down, and it's been under VWAP this whole time. So this is important. You talk about indicators that I actually like, VWAP. This has been making me money. People come in and say, oh, this is the thing that does it. It's like, no, I like a combination of things. You got to have multiple things together. One indicator isn't great, but the ones that are common, the ones that people are actually looking at are, for example, VWAP, because that'll tell you how bullish a stock is. If you want to go to the upside on a stock, if you want to purchase shares or calls or whatever it is and take advantage of an upward move, you can do that based on how it's performing against VWAP. If it's under VWAP like this all day, and then there's a point where it looks like it might break out, it's not a good bet to try to jump in there and catch that, because it's probably going to be a bull trap. If it's been under VWAP all day, everyone's been looking at it. And I mean, that's like your first day traders to your people that have been looking at it for their entire lives. They're going to be looking at that at least a little just to see where price is. Because if you just watch where it is, it tells you how the stock's going to behave on the day. If it's behaving really bearish and you see some point where it could crack to a new level, that actually could happen. Whereas if it's trying to do it to the upside and it's been down all day, you may or may not get that. And you'll just notice that it tends to pull to the direction of VWAP. It's going to go out past it as much as it can, and then it's going to get pulled back towards it and go the other way. And it just kind of sinks around it. And that's what it is. It's the average of all the trading that's going on based on the volume, which is what you need. It's one of the most basic numbers, but it's important because it shows you where most traders are, what they're feeling. If they're like this, it's not usually good. Now, this could go everywhere. I'm not making a prediction right now, but I'm saying over long time frames, if you're looking at these things, these trends tend to tell you where you might have turnarounds, because there's going to be pull in the opposite direction no matter how high you go. Like, look at the last 2 days over here. So this was Friday and Thursday. We had these big pumps. We had some kind of sideways trading where people are wondering if this is a real deal. But really, when you see this much green, it's artificial. That means it's a squeeze. So this is mostly a squeeze, but it's caused by some upward motion. And I think what's going on is people are finding that this is harder to drop than they thought, because the real economy is actually solid. They're betting on people needing to sell their shares, but fewer people may need to sell their shares than they think. And if that's the case, there will be easy support at levels that look good to buy to long-term investors. That's why you want to pay attention to long-term investors, because they're looking at the long-term VWAP, basically. Even if they're not paying attention to VWAP, they're looking at other things. They're looking at moving averages. They're looking at something, some kind of indicator that tells them where it is based on its past performance. Everything that's led up to now, where should it be? And I like having them on the charts because it shows you where the stock might go. And one thing I really like is a standard deviation channel, because it shows you the range that it's most likely to be in within a certain amount of time. And it's not always right, but it's usually a good indicator of what people are thinking is going to happen at the time. So if you're trying to make a medium-term move, it's a nice indicator of where you have the strength to do that. If you're in the middle of two high volume areas that have a lot of pull to them, that's a good sign that it's going to move one way or the other. If you're betting on movement, then there you go. You got your movement. If it's around a high volume level, it might stay there for a while. And that's what we've been looking at with the SPY, basically, well, with the market in general. So I'm using the SPY as a proxy. There are more indicators. There are indicators that people in higher up positions start to get all hoity-toity about, and they go off of those. But they're all just kind of looking at the same stuff in different languages to make themselves feel good. And you get the same result. The thing that I like about this is it shows you where the most buying and selling took place. If you look at it, there are a bunch of indicators on this one. So this is my chart that I do use indicators on. I have some that I don't, some that I do, because it's nice to take everything off and just look at it without any distractions. And these levels are telling me, okay, I want to know where the highest volume areas are and see what the trading is based on that. So I set these lines a long time ago. These are just the 3 biggest volume spots in this price action level. So these are where the volume stacks up the most. And what you'll see is every time we come up to one of these levels, we hit it and we get rejected, or we stay at it for a while before we go back down, because we're in a channel that is showing support. People aren't buying the market's going to fall completely. This recession's going to be terrible if we have one thing. There's a lot of talk about that, but most of the people with money are saying, I don't really buy it. So they're buying at these levels. When it goes below these points where most people are in, including large institutions, and I guess I should probably say mostly large institutions, because it's going to show you where the bulk of the money is going. And they're just buying in huge swaths. The companies are moving where this thing is going because they have the capital, number one. So they haven't been squeezed out yet because of rates, and because they think it's not going as low as everyone else does. And I kind of agree with them. I don't think it's done going down, but I don't think it's going to be this huge crash that people think it is. I'm sure we're going to have short-term, massive downward moves like we have. If you look at these were pretty big. This one right here, like how many straight weeks of red that's terrible. I think people were more bearish in this area and here than they were anywhere else after that. Because this was when it was all you saw was red. So the bears, they were right every single week. And when bears are right multiple weeks in a row, they get really annoying. That's the thing. Like the bulls are annoying all the time, but they're cute annoying because they think it's going up and forever. And they have this story and they're all excited about it. But then the bears, they just hate everything because they haven't made any money going up. So they're just mad and they're trying to get revenge on everybody else. But it never works because the whole thing is just to squeeze them out. They think, all right, this is it. Like, no, the option sellers are squeezing you out. They're making you think it's going to happen, but it never quite gets there. And then once in a while it gets there. So you think, aha, there you go. So you bet even harder, and then it doesn't go any farther. So the bears being right for a long period of time causes them to stack, which is why we probably started to get support in this area after here, because so many of them were short and they got caught and they had to figure out what to do about it. Especially through this pump. I mean, that's what this pump is. When I say artificial, like I did earlier, there's this much green in a row and the green is that strong. That's telling you that it's more than just buying. It's a combination of buying and getting squeezed at the same time. And there were reasons to squeeze over here because the rhetoric was so terrible and the results were not. Because we were afraid. So everybody knew that the Fed was going to start raising rates. That was the story. So free money all in this section right here. Everybody's happy. And right here, they're getting nervous, so they're starting to think, all right, what are we going to do? The Fed comes out and gives their downward projections because they're saying, all right, it's time to put pressure on the market, which is going to squeeze people out. People that are struggling or people that are doing things that they shouldn't or borrowing to excess, they're going to be squeezed at some point. And that's the whole point of this. They're trying to get these companies, these zombie companies that are just hanging on and they're leeching money off because there are ways to do that. And they're not going away when what they need to do is go away and leave the market share for the companies that are actually doing the right thing. And that's what they're trying to do. I mean, that's like I guess kind of philosophy or something like that. But I'm saying more in a realistic sense, like what they're trying to do with these policies. They're trying to squeeze out the problems by increasing the cost of money and making it harder for the people that are surviving on debt to make it. So we're moving along this channel. There's more support than people think. That's why we've had this kind of upward, lower, or higher low thing going on for a while. And if this is another one, that'll be extremely bullish because right now we're at this level of resistance. This middle line is where there is an extreme amount of buying. Over the past couple of years, this area, and this area have the most buying of this whole range. Everything after this increase. So we have the increase from the pandemic right here, right? Look at how extreme this is. So this is going back a very long time. If I zoom out all the way, you can see this is going back to the 90s when the SPY started. So you can see where we are in relative terms to the 90s, not that long ago, an era that had these crazy boom and busts, and then the early 2000s with the same exact thing because the world was changing. The world of computers, the world of automation and everything was taking over like it never had, and now it was finally having consequences in the financial markets because new people were coming in and they were seeing what all the machines were doing, so they were buying into it more. It was getting funded, and we had the dot-com pump. Right? Everybody believed that, all right, here we are. It's the internet. It's the first time we've ever done this. We're going to solve every problem ever in like 2 years. And eventually they realized like, oh, not only did we not solve those problems, but we created new ones and then we had all this crazy stuff. So we crash and then it starts pumping again because, the real estate market is making it pump like crazy. They're just getting money hand over fist for these loans that they give to everybody. Oh, wait, there's a problem with that? People can't pay it? Well, shit. So then they go down, and we have this massive pump. So this is when people were really talking about financial ruin. This is when all the gold bugs went crazy because they were so right for this short little time, and they made all this money. And then the bounce, the squeeze at the end, when it didn't keep going, because things still work. It's a narrative. People buy a narrative. That's what happens. That's why this pump becomes this crash is because people buy a narrative, not because things really did change. Now, things did change. There were two massive banks and a whole lot. I'm talking about the biggest banks in the world that went under. You don't just see two massive banks just go bankrupt overnight. That doesn't happen very often. And I mean, banks that have been around for a century or more, right here just blowing up, that doesn't happen every day. But what was going on, all the other companies that were actually doing better, that were doing, well, some of them were doing the right thing, but some of them were just functioning better in society. They weren't doing the stupid things, like they weren't borrowing in excess and spending money on crazy things. And then there's CEOs and, I mean, board of directors, I should say, that get in there and they're corrupt and they ruin the whole thing. So there's all kinds of stuff that causes this, but it's all mostly a narrative. And that narrative caused people to jack the money down to a point where it was almost free. And that started this huge pump, because if money is almost free, you might borrow it now before they start doing what they're doing right now. Rates were about this level. I think they were in the sixes, maybe sixes or sevens, before they pulled them way down. So they have not been that high in a while. But look at where the level is. We had a huge level change after the .com and the 2008 crash, because we had a double top. We had a very strong area of buying and selling that we had to pass. We also had a narrative because people didn't think we would ever get to this point again. The greatest days are over. You know, it's never going to be this good again. We're never going to come back. Well, guess what? We did, because the reality is we're going to keep pumping money into the system. That is inflation. The prices are going to go up on their own, whether we believe in them or not, just because money is going to flow out from other things. It's like water. It'll make its way everywhere. Money has strong pull. That's why it runs society. It really is like a lubrication of society, because it allows everything to function. So when people don't believe things, they dump their money, or they protect their money, or they spend their money irrationally, and you get stuff like this. And then you have people denying it and shorting it all the way up, because every time we get to this point, they think, nope, we're not as good as we were here. We're not as good as we were there. It's never happening. And then eventually that point becomes the support for the next level. And we were at a new level until we had a bunch of craziness with the trade war and everything, because everything was going smooth. Rates were going up, but they were going up slowly. We had an election that was finished. All the cares, well, most of the cares were behind us or in front of us. So we had this little period of time where it could just go up for a while and not worry about anything. But then we had the trade war, and we had this mess where everything went into craziness. We had rate changes here. It got too high when it actually died back here. It got too high, and it crashed. And then we bounced because we dropped rates, you know, and that drop brought this pump on, and people didn't believe in this pump either. It was the exact same narrative. Now, I got into this around this craziness. So when I saw this point, I thought, yeah, I agree. There's no way it's coming back. I believed it wasn't coming back. And look, we had a level change. That's what happens every time. People think they know exactly what a stock's going to do, or they don't think they know exactly what it's going to do, but they think they have a better idea than they actually do. Because what happens is the capital flows in and just causes the pressure to blow everything up like a balloon. If you just add a zero to everything, things are still the same. And I know there's people that argue against that, but I'm saying mentally, that's basically the case. If you have whatever it is when you grow up, you'll kind of relate prices to that point. You'll think that's what prices are, and they're expensive now because of that. No, they were expensive back then. They've been getting expensive forever. We've had inflation forever, and it causes problems like this. But really, actually, it's not the inflation so much as the corruption. That's really what it is. Inflation is natural. That's why they want a 2% inflation, because they want some money to keep bringing the economy up. They're talking about how much of the GDP the Fed's balance sheet is. It's like 30% or something like that. It's a massive point. So they have all this cash, and the more they have, oh, look, GDP goes up because we have more stuff here. Our balloon is bigger, right? And that's what we're doing. We're just riding this balloon up. And people say, yeah, it's going to pop. Yeah, probably. I'm sure it's a balloon. It'll pop. Yeah. Everything's moved. Look at how it moves. It's terrible. Suffering through this drop and then having to wait to come back. Like that's terrible. Why you'd want something that just flows nice and easy. Doesn't have to be perfect, but it's not going like this across the channel. But look at this. Look at where the standard deviation channels are. It kind of bounces off those areas. That's why I like to put these on there, because even though they're kind of ridiculous sometimes, they do kind of show you a decent range to look at. If you want an idea of where it might be and you want to plan your trade based on that, that's a good indicator to look at. You don't have too much else on the screen to get crazy. I don't like these year marking lines right now because they're kind of getting in my way. But that tells you how long it's been. You can see each year, which is nice too, because you can see these drops. They last at most a year or two in the modern era, and usually just a few months. So we have the first sideways action in quite a while, because everything else is kind of pumped, or it's been down, up, down, up. So we're seeing this point where we're actually getting resistance. And that's why I think, depending upon what happens coming up soon, like in the next quarter and the next couple of Fed meetings, we'll see if we can break this level of volume resistance right here. So there's all kinds of levels you can look at. This is the weekly chart. So all these candles, each one of these candles is a week. This line is the average price basically. And these levels are the points at which the most shareholders exchanged shares. And that's important because people will base their risk off those points. So knowing where they're thinking about, there's a whole psychological thing to how you view your money and how you view it when it's in trouble or when it's winning in the stock market. When your money is active, there's emotion attached to that, and it causes movements. It causes people to do things rationally or irrationally, but it's also what causes this wavy pattern because we get this flow. You know, we're humans. We're made out of water. We kind of flow like water, and that's what our ideas are doing. They're bouncing around like in this little liquid sort of form, but in a trend line. So you can see, looking at it over the week, these averages and these lines are providing areas where action happens. There's quick movement when you get to these levels. They don't like to go beyond this because a lot of people have shares at this point. When it comes above that point, it bounces off something else. That's a point where it struggles before it gets back down because a lot of people got rid of their shares or are willing to get back into them. So some people are buying in here and they're getting rid of it up here, and that's where they'll be willing to do it again if it comes back down. So people that buy at the top and they get crushed and they want to get out, they sell to those people that are thinking, well, maybe I'll do it again. You know, I bought in down here. I didn't buy in up here. Maybe I'll buy in down here. I'll let it go and buy some more or something. So there's people that are thinking of it like that. And the ones with the money are the ones that are going to control it. Because if people have a lot of money and they believe in something, they're just not going to let the shares go. So the how many shares are available and how easy shares are to get kind of tells you everything. And when you're looking at the SPY, you're looking at a general sense of what people think about the market, which is why I like this. So at this point, we're sort of bouncing between these two volume areas. That's what I've been thinking about for the past couple of months. These levels seem to provide areas where they actually turn around, and so do the standard deviation lines. So what are we going to do when we're in between two high volume areas? We're pretty close to the middle of those two areas. So if we have movement, it'll probably be quickly like it is in these other candles. You can see pretty much every time it gets to this level, it bounces hard, or it goes up here, it goes down quickly, and this is where it sort of sits. So are we going to be rejected back down here, or is this the start of the next leg up? I don't know. I think we're going to have a little bit of downward movement because we've had some interesting news that hasn't seemed to go through the market properly yet. There are times where news just causes massive movements, and there are times that it doesn't. And those times that it doesn't, that's when people are distracted with something else and are finding out about this later after the main traders have made their moves already. So their panic can cause things to change, which is nice. And that's what's good about this middle level right here. It could move so quickly based on how people feel about it. And one thing I've been looking at is the data. So the data is usually more reliable than the media because you listen to the media and they tell you one thing, you get one, some idea in your head. They sort of tell you about everything so they can be like, yeah, we show all sides, but they definitely have a bias. They lean towards something, and whatever it is will cause movements too because it's all in the psychological realm. So they're trying to move the stock through psychology, and they're only having so much of an effect on it because this is everything that's going on in the world plus all the narratives flowing through the media. That's what's causing this movement. So I'm not thinking it's just one entity or one thing that's moving it. I don't get into this like, oh, this one entity caused this movement. I know it was them. And you probably could, if you looked at things really closely, you could see who was buying most of the shares. And I'm sure at some point, everything is so simplified that there would be certain companies that buy more than anybody else. But that doesn't necessarily mean you'd be able to predict the movements of the market off of that. So I'm just trying to use it as a guide to the psychology of the world right now. What are we thinking? What is most of the world thinking? Because if you're trading, you're at least looking at this in some way. If you're in another country, you're paying attention to the U.S. market just like everyone else, because it does have influence over the dollar and how the dollar performs against other currencies, which can move everything. Like certain currencies don't interact with each other, so a movement in one doesn't necessarily provoke a movement in another. But with the dollar, you get a movement in a lot of different things because they all react to each other. Everything is so reactionary in the stock market now because you're trading against algos. Like there are real people out there making trades, but the algos are kind of doing it slyly. They're trying to do it in ways that they can profit a little bit more because the market is so complicated and it's not easy to predict what you're going to be able to do in certain circumstances. So if you just set yourself up for as many different possibilities as you can, you'll be able to survive these huge movements and then continue your thesis, which will then have positive or negative impacts on the market. And usually to the upside, that's what we get because we have the weight of inflation pushing on us. So if you think, all right, it's going up, it's going down, whatever, what pressure do you have behind it besides the ideas that lead you to think it's going down. Because yeah, maybe logically it sounds like it should go down, but does it have pressure to the downside from other things? There's always pressure to the upside from inflation. And the worse inflation is, the more that pressure is. In the short term, people get scared of it and they run, they sell. But that doesn't mean all the money disappears. It means the right players are getting out at the right time and everybody else is being stuck in the middle holding the bag. And that's the point where most people lose money and give up, and then end up coming back later. Statistically, people leave and come back multiple times. It's not like one thing and they're done. If that was the case, the 2008 crash would have just completely ended it. But it's more popular now than ever. Like, everybody trades, it's not even, it's a little thing now. I talk to people you wouldn't have expected to, like, yeah, I got Robinhood and I made $1,000 or whatever. I was like, yeah, I know you didn't. You lost like $10,000, didn't you? But hey, you know what? They at least did it because it's easy to go overboard. It's human nature. We try to blame it on other things. We try to blame it on all this stuff and say, oh, it's everybody's fault. Like, no, it's human nature. People are going to do the things that they're going to do. They're going to take the risks that they want to take. We're kind of almost hardwired to take certain amount of risks because it pays off. Statistically, if you take the right type of risks at the right time over and over again, eventually they're going to be right. And if you don't have that much of a cost to being wrong, you can stay in the game long enough to catch a ride on the right wave. And that's what you could happen in this stage. Because here's where we are right now. Last year, we were in the downward cycle, right? There's like the market cycle that goes from elation to a bubble popping to everybody freaking out and panicking. And then it gets to a point where it kind of consolidates. And we get this sideways action because everybody still thinks it's going down. They haven't realized that we're in the sideways action point yet. They're still in the going down part. And the sideways action doesn't necessarily mean that we're not going to go down. It just means that sentiment, that directionality of the trend is altered. And it's more towards the sideways area. Because even if we're going down, we have these corrections because there's always some news story. There's always something that pumps it when we dump really, really hard. It's never a continued drop because of anything, because there are still plenty of businesses and there's still everything. People are doing all right? Like there's a lot of terrible things going on, but for the most part, the people that are active and have been active in the markets for a long time are still just doing what they do. They're holding their positions and they're waiting because that's how you survive. If you're betting on inflation just pumping the price of things up, it's best just to sit there and chill and take your losses, and instead of crying about it and not wanting to come back, because that does happen. I mean, I've done it. I do it like every couple of months, It's like you get all upset. You're like, I'm never doing it, and then you do it again, and you just learn from it and you get better over time, and the losses don't become so bad. It's like now, a few years ago, I would lose a good amount of money doing something dumb and then feel really bad about it and do it again. Now I scale things down slowly so that if I find something that actually works, I can scale into it properly. And that's so much easier, like putting your foot in the water a little bit at the right time, because knowing that you could miss things and be okay with like only buying a tiny bit, but scaling yourself in slowly, if you really believe in a position, is not a bad way to go in an environment like this and an environment like we had last year, because it's going to keep going down. And the reason I say sideways isn't because it's going to go directly sideways, is because we're going to have these corrections for some reason. And when we get to these levels, people are going to react to it. And we'll have to see what they do when we get to higher volume levels, which right now we're in the middle of. So when they get to this one, if we go down, are we going to get a lot of people that are going to panic, or is this going to be seen as a buying opportunity? If things are good enough, it's going to be a buying opportunity, and it'll provide a spring to breaking through this next level, which has been resistance for a long time. We broke above it when we had that squeeze last year, and then we got about halfway or a little bit past halfway to the next volume level, and then crashed down in this big, massive one right here. So we had these were artificial too. So our trend really wasn't this crazy thing. It was just kind of like this, but we had to overdo it like we always do because we're crazy about it. And we got to the middle of that trend line last year. So we dropped for the first half of the year, and then we went sideways. But if you ask anybody, the whole year was a drop. Right? They'll say there were those, but in your mind, all you remember is the drop. But you don't remember that we hit a new phase since we've been in this sideways section for so long now. Now this is providing more and more resistance because people, or I should say support. This is providing more and more support because people are becoming more and more bullish. Consumer sentiment, for example, is up. It's showing you that people think the market is going up. They don't necessarily think it's going to be down as far as other people do. So confidence is causing people to buy. These surveys keep saying that. They keep saying that slowly but surely people are starting to come back to the market. They're being a little more responsible. They're just kind of waiting it out. And we're seeing that people didn't just leave, and they're not everybody's blowing up. People are making responsible choices too. It's not just like the Robinhood YOLOer that blows up his account. You know, that's the story you always see on TV. It's, look at what this guy lost. He lost thousands on calls, and now he doesn't have a retirement fund or whatever. Yeah. That's because those are not super common occurrences. People aren't usually that dumb. Some people are, and some people do it and it pays off. That's why you got other people dumb enough to try it. But for the most part, no, people don't do that. You're not going to risk everything you have for these stupid gains because you know there's a high likelihood that you're going to be wrong. Anybody that's been in this game long enough knows that there is a high likelihood that you're going to be wrong, because you have to be able to survive those times of being wrong. Because if you put too much in and you're wrong over and over again, you get to a point emotionally where you can't take it. It's not just the fact that financially you can't take it, but you've done such a toll on your brain from the stress that you put on yourself by scaling in too much that physical damage is done. It's like anything else. It's actual mental trauma if you do stuff like that. And I mean, everybody has to try at least a little bit of it. I didn't go crazy with it, but I do know how that feels. So that's why I scale back. Because because of losing so bad, I thought it's okay to just miss out. It's okay to buy 10 shares because you're just kind of sitting there looking at like, what am I going to do with this thing? And then it goes, you're like, oh, well, I made, $3 or whatever. I didn't really want to do that. That is better than, oh man, I just lost $10,000 overnight, or I lost whatever percentage of money is a lot to me overnight. Because that can happen and that can cause you to just quit. But then there are people that say, no, I can't quit. I have to make it back. And they're never going to trade again as soon as they do. And it's this big emotional roller coaster. There are just so many different ways that people stress themselves out doing this. So when you look at the charts and you see that there are people that are rational and there are people that are irrational, you see the movement of everything in these charts. And right now we have bullish sentiment because we've had these higher lows up to this point. Now, is next week going to be a crash? Are we going to go sideways? What is it? I don't know, but we had basically a pump, because my last show was somewhere around here. We had finished, it was the very first of the year. So we had finished down and it looked like, we were sideways, which is what I said, but people were thinking, oh, it's bad. And then we just bounced like crazy because that's what people didn't expect that. And I mean, actually a lot of people did expect that because it happens when we close down, because it's a chance for people to reposition themselves into something that they actually want. Because these years, people are stuck in things they hate and they want to get rid of them. I guess that's the good thing about the psychological toll this thing plays on people. You sit there with a position you shouldn't have, and every time it goes down, you just keep thinking like, I can't lose all this money on it. This has to work. You're thinking about all these things, and you're trying to talk to the universe and tell it. Hopefully, your stock will turn around or whatever. But it never does at that point. I mean, you're done. So you have a long-term view on things, or you have a lot of skills and you trade short-term, but you get used to the waves and the directionality of the market. And if you just scale in slowly, you're going to get hurt on these down years, yes, but you're not going to get destroyed to the point where you don't want to ever trade again. You just want to get back to even, you're never touching it again, and then you never do, or that it's like this psychological trauma that has physical consequences if it's bad enough. So it's better to just stay away from that and be smart about it. Go talk to somebody that actually knows what they're doing financially. Like really, that's what everybody should do, is go find some financial person that they trust more than them and ask for their opinion. Whether you do it or not is a whole different thing, but having an outside opinion from somebody that knows what they're doing is a good idea. So you can base what you're doing financially off of what most people do or don't do. It's nice to just have kind of a basis to start from. And it's also nice to know that your opinions are at least valid too. So even if you come across other opinions, it's something that you have to think about. It's something that you have to expand your viewpoint to take into account, which is good because that gives you a better view of what's actually going on. The charts kind of they form a picture over time. If you look at it, it's partly science, partly an art. And the art part of it makes it look like there is something going on. There's a lot of artificial green squeezing going on. All right, there's a lot of capital holding the market up when it actually should go lower. So I'm not saying that the bears are wrong, right? I was making fun of the bears, but they're actually right about a lot of what they're saying. That's the thing. The bears are right. Okay, they're mad because they know they're right, but it's not dropping the way they think it should. That's what always happens, because this is a fake system, and the people in control of it are going to use their money how they're going to use it, and it's probably going to be to keep that system going, because that's the system that keeps them in power and keeps everything going the way it is. So they want it to survive. So if they have to just let it inflate to survive, they're going to let it inflate. And everybody else, the bears, they're fighting against the natural inflation of people's need to continue to exist. That's what this whole thing is. We need an economy so that everything functions. That's why we need this right now, because we could change it. We could have all the debates about it, but to drastically change everything overnight just isn't going to happen. So it has to run. It has to like wind down. If you turn this economy off, it's like turning off an engine. It's going to have to slowly start to go back to a neutral state, and then it's good. It's not like everything just instantly changes. So you're fighting against these forces, or you shouldn't be fighting against these forces. You should just be watching what's going on and reacting to that. Because it's so much easier than trying to fight for an idea. Like that's the reason it never goes down with the bears. They have this idea and they're logically right about it. So their emotions and their mind are stuck on actually making this happen, because they know that it's going to happen. But because they're fighting against the natural flow of air, they're in the balloon. They're trying to fight against the air coming into the balloon. They know it's going to pop eventually, but it's not easy to try to push against that when all this air is naturally coming in. You're expending all your energy trying to do that, but there's more force behind the air coming in. And that's what's going on with the balloon. The bears are providing even more, because then they have to cover when it doesn't fall. So the artificial nature is keeping it afloat. The reason that it's broken is the reason that it's afloat, because it is broken and it gets squeezed because of that. They need a reason for bears. There is a real reason for bears. There are many, and it's bringing them in, and they keep supplying the money to keep the system they hate going. That's the tragic reality of how our system works. So we're just letting this go right now. And if you're watching it, it's bullish. But I think we are setting a bull trap as well. So all that being said, I also think there's a bull trap being set in the minds of the neutral, right? So there's the bulls, the bears, the neutral. I think the neutral, which is kind of the majority, basically, they're either really educated and they know exactly what they're doing, or they've barely even looked at it. It's the whole range of people. Whereas the really hardcore bears and bulls are sort of similar in a lot of ways. They have similarities. They work in similar ways, but the mass of people outnumbers them. It's like the pressure. They have the pressure. So it's good to watch what they're doing too. And the spy gives me that idea. So yes, there are entities that can react and actually move beyond everybody's ability to stop that. That's true. But it doesn't, because people want that system to continue the way it is, which is keeping it afloat when it gets down to these levels where there are a lot of people. So the people that are in these levels aren't just everyday retailers. This is the people with a lot of money. The people with the most money that make the biggest dent in the chart are showing up. Like if you're throwing a bunch of rocks at something and this huge boulder comes and makes a huge dent in it, that's what you're seeing with this. You're seeing not only everybody else is buying at the time, you're seeing the entities that have the money to move buying at this time, which is why it's hard to pass this area, because there are huge entities that are either short or they've gotten out of it and they're not really sure about getting back in yet. Or they're underwater and they want to get back. But the higher consumer sentiment is, the less that happens. The more people believe in this and continue to buy. Well, the people that are like the swing voters in elections, they kind of just go back and forth between what they think in the market. And that force is not easy to fight against. If you follow that trend, if you were buying in down here, you did well up here. So what I ended up doing last year is, when everything dropped at the end of the year, I had bought a bunch of stuff. I was right here. I mean, I think I sold in some of these pumps a little bit, but mostly what I was doing in the years was buying the stuff that I wanted for next year, because even up here, prices for certain things were so low because people were panicking that it's comparable to what's going on here. So I was able to buy things in this area when everything was crazy that were still worth money at this point, or were even up. And then after the beginning of the year, they started to pump, which is what I thought. So I got rid of some of that because I wanted to make sure that I had at least some capital if we do have a dump, since we're going between two strong volume areas. So I let a bunch of that go and went into cash, but I kept my long-term positions and I've been adding to those. So through this whole point, I was adding to my long positions when I could. And the lower it got, the more I added, because these drops, like right in here, was great. I bought so much stuff after this because it wasn't just the long-term effects of this. It was this short-term pump and then dump. And I knew that we might have a chance to have some kind of settling right here because of this volume level. So we just smashed below it. And when you smash below something so quickly like this, this because if you look at it, that does not happen very often. You get a reaction. So having this pull, regardless of what the news was not surprising to me. I kind of thought this is the area. So when it smashed way down here and it was really bearish, I was buying things to the upside, and then I could have held longer. I could have held through this, which is a shame. I actually didn't, because this was amazing. But just getting back to this point was all I was trying to do. And getting that much was just enough to be like, all right, I'm happy with this. So I had that, and then I had some other bets that I went on that didn't really go so well. And that's okay, because, you get those sometimes. But in this case, these were small. I just went for like a few option contracts at a time of very cheap stocks, so it wasn't a big deal. And those didn't go well because they normally don't. But most of the stuff that I was looking at for my long portfolio, I was looking at Tesla. Facebook in this point right here. Meta was great. I was buying Meta hand over fist when it was down in the low 100s. And I remember there were all these people that were posting on message boards that Facebook was terrible, was going under, everything was done. But at that point, I was thinking, no, it's not. It's just because the metaverse is ridiculous and it's, they don't have legs or whatever, that they're having trouble with hands, whatever the problem was at the time. I was looking at everything else and going, no, this has merit. This will continue to go. Whether their version of it does or not, the concept is going to take off. And it already is, because it's useful. Who doesn't want to just lie in their bed and do their entire day? That's what we're looking at with future society. We're not just looking at these things here and there, these little inventions. We're looking at the ability to go through your entire day virtually as if it's your real day, to be in those places with augmented reality, to be in your house and also be in the office, and everybody sees you in the office, and you only go you meet in person once in a while, and it makes sense. It's not like I'm saying one thing or another about what we should do in the labor market versus, no, I'm just saying, like, it makes sense that it when you don't feel good, you'd rather just lie there all day, right? And now you could do that and still go into work, and it wouldn't be that big of a deal. You could spend so much time doing stuff at work and not even being there, because if you need to do something at home, you're still there. That's extremely useful. So I don't see that going away, and I see as people grow up in this society, they're going to do that more and more. So when I was looking at this thing, I was thinking people are just looking at the ridiculousness of not having legs on their avatars. That literally was it. Oh, they don't have legs. They don't have legs. That's all you heard about it. But what about, like, hey, you could lie in your bed and go to work. Are you not paying attention at that point? Yeah, but anybody could do that. Yeah, but Facebook has the reach of 3 billion people. Facebook has an amazing balance sheet. Facebook has all these other companies. It's not just a bunch of jackoffs in a fucking garage. Like, there are a bunch of these projects that are good, but it really is just some people in a garage, and just the slightest financial problem could ruin the whole thing. So it's not. That's what we're looking at here with this graph. We're looking at this mixture of everything. And my point is that I'm right now, I don't know whether it's going to go up or down, but I do see this as a strong area of resistance on either side. I think we could go sideways for a while. We'll probably dip below it, probably go above it. But for the most part, because we're going to have actual economic repercussions of the things we've been doing now, we're going to see some slowing in profits, which means stock prices have to compensate by coming down. They're all valued based on what people think the stocks are going to be worth in the future. It's not just about the numbers. It's all about what do people say the projections say they'll be valued. And people can make projections whatever they want. And eventually, most companies are smart, and they try to do it right because they know if they lie, they'll get in trouble, and it's pointless to lie because you can just tell the truth and still get the same outcome with how everything works. People barring against it, people going crazy with your stock, whatever it is. Just tell the truth and take advantage of the craziness. That's basically what I'm trying to do with my whole thing. It's like, yes, I know the market's crazy. I know the world is crazy. I know it might be extremely manipulated. It might not be manipulated at all, whatever. But there's still a craziness to it. And it's okay to just step back and watch the thing go. So that's what I'm doing right now. I got out of a bunch of positions that I had purchased on this drop. So that's the point I was trying to make. On this drop, I was extremely bullish for the beginning of the year. And I was right, because there was just too much negativity and too much selling, more importantly. Not just the negativity. Everyone's like, oh, if everyone's negative, got to be positive. No, it's not just about that. It's about that plus the numbers. What do the numbers say? If people are negative but the numbers are good, yeah, you can bet against the mindset. But if people are negative and the numbers are terrible, then you might want to watch out. That's all you have to do. You don't have to go over this crazy shit and know every little indicator in the book. No, you just need to be like, all right, everybody else knows more than me, or the market knows more than me. So I'm just going to sit back. I'm going to do what I have to maintain a strategy. So my strategy is I have a long account, I have a trading account, and then I have some cash. And that's my whole thing is basically you have your retirement, Whatever that is, that's one thing. But if you're doing everything yourself or doing it on top of that, my thought is to just have a little bit of money to sit there and grow interest in some way, whatever it is. It could be a bond. It could just sit in cash and collect interest in some account. It doesn't matter as long as it's sitting there doing something so that it's not getting drained quite as much by inflation. And then I have the positions that I believe in long term. Because what I've noticed is long-term positions are the ones that work the best. All those studies that say, yeah, it's better to just buy over time are right. Because if you look at the chart over time, it's straight up. I mean, if I back this thing up, it's just nothing but up as far back as you go. This is only 1994. You can go back to 1800 or whatever. It's the same thing. It's just up and up and up and up. So you're going to get drops for a while. You got to listen to the bears for a little bit. You can't just say that they're wrong all the time. But the problem is that what they say works itself into the market. And the people that don't believe it just don't leave. And the people that do believe it react. And eventually, one side exhausts their ammo. And once that happens, a turnaround occurs. So we have this turnaround because people weren't negative enough to believe it was going to go lower. We were already bad. We were better than people were saying. We had gotten to a point where we were above the pre and post-pandemic high. So we went before the pandemic drop. We had this massive drop right here. This was insane. We were at about 340-ish, low 340s, I think, maybe high 330s, and we dropped all the way down to the low 200s. I mean, it was scary at one point. This was a quick drop. This was the fastest drop in history if you go and look back at it in the charts. I mean, there could be some other stuff that's probably bigger than that, but if from modern economics, this is basically the biggest and quickest drop we've ever had, and that's because of our highly levered economy. And I mean, we had a highly levered economy 100 years ago. It's not a joke about this being new. This is just an extended form of what we've had for the longest time. So we had this massive drop, and then we had a reaction to it because there were tools in the Fed's toolbox. There still are. Even beyond this, there were still things they could have done to bring it back. So people that don't believe in the economy think all their tools are exhausted and they bet against it. And the Fed goes, no, we're actually just going to do this other thing. We're just going to take some junk bonds now. Or why don't we just take that? Nobody would ever, we've never done it before. Like, crap. Well, here we go. So we took off and rates were cheap. Everybody was getting money. And now we had this crazy drop last year. And now we're kind of transitioning into the sideways phase. So it doesn't mean we're not going to drop more, which I think we will. But that just says that we're not in the same... We're not in free fall anymore. Last year we were in free fall, because if you change this to, let's go to months, change it to months, you can see how we did on a longer term time frame. So it was basically most of the time dropping, but we'd have these little bounces, which is always normal because of how the system works. And we went to these levels. Look at so I don't look at this that often, but look at how these levels held up on the monthly. So I drew these on the weekly, most likely, because that's the time frame I pay attention to, because that gives me a little bit of the short term feel of it, and it also gives me a long term feel of it. And it's a way to see a larger weight. I want to see as much weight as possible without distorting the picture, because eventually you can kind of see what's going on with the market if you find the right price level. And the right price level is a mix of price levels, not just one. But having a good long-term one, I think, helps. So I like to look at all of them, but the week is how I start things. And then I go into the other ones and see how it stacks up. And that's, if you look at these levels, we had big movement between the points. Big movement between the points, but we have a lot of settling when we get to the high volume points. So that's how you can see when we're in these levels, we move quickly. So I'm expecting, if we're compressing right here, we're going to pop to one way or the other. We're going to actually have some force to move to the next level. So a level change, like I was talking about earlier, happens when you get to a point and all the trading beyond that point doesn't even come close to bringing you below it. So we had a level change from the pandemic bottom to the top, right? For sure. This was a level change, big time. And then we had another level change after that. In fact, we had a couple more, because those volume points are basically the level changes. And when you get in between those, you get quick movements. That's why you get this sudden level change up to here, because people were really sure right here. And when they got to this point, some other people were getting out to take profits, but there were still a bunch of bulls, and there was still way more free, or almost free, cash available. So that caused things to just pump. And betting against that would have been tough. However, this is when the Fed said, okay, we're going to start talking about this interest rate thing. So that's when people said, all right, next year it's time to adjust our positions. And you'll see changes at the beginning of the year frequently. That was one of the other reasons why I thought we were going to bounce, because there is such a huge difference between what's going on the last day of this year and the first day of this year. Every single year, it's the same thing. And nobody thought that the first 3 months of 2020, we would have this massive drop. This is huge. People were up at all-time highs. So we went from all-time highs back to levels we hadn't seen in years. And then we had this massive pump because of that. And this massive pump brought in a lot of people. So the people that are in the market right now that finally have experience started in this point. So now they're making decisions based on this and now this. And this is a very fresh open wound in those people's eyes. So this is making them skittish in these areas because they know if they get some gains, it can be taken away so quickly. Look at where, if you were just in one place, if you held for 1 month, or I should say 2 months, like you picked it up for, 1 month. So let's say you picked it up in this area and a month later you're like down here somewhere. That would be scary. That's all you know, and you just started right here. You'd get out of that, you'd run, or maybe you'd hold, you'd bounce back, and you'd feel a little better. But again, you'd think, oh, I should have sold. I knew I should have sold. And just seeing your stuff go down after you had a chance to get out is so frustrating. That's one of the positions that I hate being in. You're thinking like, oh, I could have sold that, and then I wouldn't be in this position right now. My face wouldn't hurt, but you get to that point, and it gets extremely volatile. There's so much weight bringing it back. And I thought, all right, with all this weight right here, and with the fact that money's not free anymore, we're having this huge increase. It's a really big increase. People are not paying attention to how big this interest rate increase is. So it's not the fact that, oh, are we going to stop and then sit there, or are we going to pivot? No, it's the fact that we have massive pressure suddenly on the market. Some people are just sitting there feeling like nothing has changed, because a lot of people, it hasn't. To a lot of people, this is just nothing. They haven't made these kind of risky bets, and they're just sitting there doing their thing. Everybody else is the one that's chasing their tail right now and causing this massive spin up and down. So finally, after this year of madness, we had repositioning, and people that were betting on these terrible companies in these times, and not just new people, but everybody. During this time, there was so much temptation to get in on anything. Because look at how green this was. Look at how steady this movement was. This felt nice. Well, actually, it didn't for me, because I was out by the time it got up to these points. I mean, not out on everything, but most of the things that I would have made a bunch of money on were the ones I got out of by the time I got here. I did that so many times. I was in something from such a low level that I got out at a point thinking, oh man, I got really far with this one. This is great. But then it just keeps going. And you think, oh, I just could have held it even just a few more days. It would have been an insane amount. It happens. So at this point, I'm letting go, but that hurt. But other people were enjoying this. They were just buying stuff and talking about how, oh, just buy this and it works. Yeah, I know. If you don't have any fear of anything, yeah, you can just buy whatever you want. But as soon as you gain some fear, which people finally have, these people who are talking about just buy whatever, they're either out or they got a dose of reality, and now they're skittish. Things are coming back. They were betting against it at some point at the wrong time. Probably they probably held through all of it and started betting against it in here, and then they're like, oh no, it came back, but it went down again. Yeah, somebody be right. No, so this is humbling right here. When you get so frustrated by this and you switch at the wrong time, that's when the brakes are being applied. Most people that are being dragged by this are accelerating when the brakes are being put on. So they're smashing into these walls, and we're getting the remains, right? We're getting whatever's left. So that's what we have right here. We have the tough ones from this, we have the veterans, and we have the new ones, because we're starting to generate a new crowd of people that are coming into the market. It's not huge like it was in 2020 and 2021, not even close, but it is a turnaround in some way, because I'm seeing more interest about it. Slightly more interest, even when things are bad. There's not as much there's not bearish news going around in the same capacity that there was last year. And the people that are getting into this are being a little bit more careful too, because there's so much good information out there about trading. Learning trading anytime after the year 2000, after the year 2000, let's go a little bit later to social media. So after about 2008, 2010, when things really started to pick up, you could learn this stuff relatively easily. But today, there are so many better videos out because more people are making videos. There's so much better content that people are getting into this with better knowledge. They know what's actually happening when these moves go down. They don't know how to trade it, but they have a better idea because they're not being misled on like, oh, you got to get this one indicator. Look at this fish hook. Get the fish hook. There's this commercial that used to come up that goes, there's a fish hook pattern. Yeah, I know. It looks like that, but try to trade that. You get these little bits of it or something. I mean, yeah, you could try to find those. That's not a terrible strategy, but at the same time, that's really hard because you don't, if you're expecting that, you trade it at the wrong times, and like, it's just easier to go long term instead of trying to have to perfectly time those little dips. And the people that do those trading things, like they win big sometimes, yeah, because those are huge movements. But man, they get crushed a lot, and that's just the way it goes. So I'd rather do something where you don't get crushed that much before you make a huge amount in wins. Like, here's your fish hook. Look, there's one right here on the long term, right? If you look at it at a long term, then you can get that fish hook. So that's what I'm saying. Is like a lot of these patterns that people talk about, it's not so much for the 1 minute, it's not for the 1 day or whatever. It might be for the 1 month or the 1 quarter or the 1 week or something like that. So this is why I like looking at those, because if I see massive selling like that, and then I see economic reasons for it to not go as low as people think, then that's when you can see that there might be a bottom. And I don't think this was a bottom. I do think we're going to break this at some point, but I think this was kind of an indicator that people were expecting that a bottom was close. That's what I was saying at this time. I was saying, like, we've had a bunch of drops, but people are starting to think that there's a bottom. And through this whole mess right here, nobody was thinking that. But look at what happened after that. Even though we've had some downward movement, we didn't actually come all the way down or below that point because more people were believing in it. We're going to need people to push this below that because this area of volume does have pull. But if we get that, we could bust right through all of that and have crazy drops and stuff. But most likely, we're going to have people that think it's a better and better deal as we get lower and lower. And that's why I think we reach these high volume points, because I only added it for this section right here. I'm going to have to go back and add the volume points down here because there are a couple more. They're not as big as the ones up here because this whole mess was massive. And you can see the volume of that time was more than we had in this section right here. We got a lot of repositioning. We got a lot of people that were in because this was a great value for them at the time. Those are big players. Like this point right here was great for the people that had the money to buy. I remember I was expecting some kind of a good downside movement because of how much up we'd had and all the craziness we'd had with the repo market at the end of 2019. But I wasn't expecting this whole thing because the COVID thing knocked everything out of whack. But I was expecting something, so I was short, and I was right. But I got out too soon, and I didn't expect the bounce, and then I didn't expect the bounce to last. So this whole section was just, I got thrown through the tumbler, man. This is when I shorted Tesla. Like, that's how bad my life was at that point. So I had 2 really bad points in my trading career, and that was one of them. Like that, being so right, not taking advantage of it in the way I should have, and then being so wrong and being so wrong again, just getting through this whole section and thinking, man, like I have no idea what I'm doing. And finally believing in the economy when it's a little bit too late, and then by that point, I don't really want to buy because we're so inflated and we're talking about, oh, this is going to change, so like my belief in the economy just eventually had to get to not the economy, in the market. My belief in the market had to get to a point where I thought it was going to continue to go up. So it finally did until this point when the Fed said basically it's not going to go up. We're done here. I mean, that's when everybody knew that it was over, but we didn't know exactly when. The year marking line was a point that was likely, and sure enough, it was. That was where things actually did turn around, and we got down to this point where now we're kind of going sideways for a while because we have belief. We still have bears, but we have bulls, and we have this equal match between them. And these volume lines are kind of acting like support and resistance right now and holding us between that point. But at some point, we're going to break above or below this. And I don't know which way it's going to be. I suspect over time it's going to be up, but I have a feeling we're setting up for a nice drop, like a really, really good small-term drop that'll scare some people out of the market. Not like to the point where everything, the trend completely changes, but we've had a couple of pretty bad days, but we haven't had those like weeks where the selling just never ends and there's no way to escape it. They're always up down weeks. You always have these like crazy down days, and then there's a crazy up to follow it. It just keeps happening over and over again, and maybe you'll go sideways for one day, and then it'll like the whole thing just is, it's a timed effort of up. It's just up. So after a while, you don't fight against it and let it go. And at this point, we're at a stage where we need to get past this level or go below it. And I've been talking about this for a while. I've got a whole bunch of stuff to say, but I don't have a ton of time to say it. I had all these technical problems today, so I'm just going to go over my notes real quick, and I'm going to look at what I was trying to talk about. So my main point here was that we're in a new market cycle. We're in a new phase of the market cycle. We're at the point where people are starting to believe that there's a bottom somewhere. Not that the bottom is in yet. That's what people don't get about sideways movement. It doesn't necessarily mean the bottom's in. It doesn't mean we won't go lower. And it also it doesn't mean we won't go higher. because I do think there's a really good chance that this move that we're seeing is a continued uptrend, even if we have some more volatility. I think we have a high likelihood of that, but I also think we're going to have a retracement of that because we haven't had the reality of the slowdowns enter everything yet. It should start entering in the next couple of quarters. Finally start seeing some impact of the policy changes, of the companies that have been trying to hold on but are starting to struggle, of the companies that are doing just fine and are starting to eat up market share because the struggling companies aren't able to keep up. I mean, it's a chance for the immune system of the economy to kind of take care of itself. That's the good thing about the system we have. With all its problems, it's corruption. Like, the corruption of the system is what makes things bad. But if you look at how the system functions, like if it's like it's an organism, you'll see that it has an immune system that goes around and actually cleans things up on its own. And that's what the pressure is supposed to be. It's not like, I mean, there's so much thought that goes into this. There's so many levels above anything that I could ever even understand about the subject that goes into this. Yes. But at a basic point, it's just how much is flowing into there at the time. And that's what they're looking at. And if they're expanding its ability to flow in, or they're constricting it, that will affect who can continue swimming in the lake. So right now, they're putting the pressure on, and people that can't keep up with it are going to be the ones that are going to be flushed out. And some people, it's tragic. Some people, they shouldn't be in that situation. And that's the terrible part of the economy. But there are also the people that should be in that, or that should be flushed out from that position because they are doing terrible things. They're taking advantage of the system. They're insider trading. They're lying to their investors. They're putting out news stories on major media networks because they have influence that they blatantly know are false. And there will be people that get in trouble for this years in the future. What do you know? After everything doesn't matter anymore, they're going to come back and finally start like, oh, you shouldn't have done that. I'm like, oh, yeah, I know, youth, huh? Ooh, too bad. So isn't it nice how I'm a changed person now? You know, that's what's going to happen with all this. But at the same time, the people that are just being idiots about it, and they are idiots, at least the people that are really good at it don't want to crash the system because it's benefiting them too. Like, the parasite doesn't want to kill the host. The parasite just wants to take as much as it can without killing the host so that it has the benefit of everything. It's not about so much being symbiotic. It just happens to be symbiotic because whoever is in there at the smallest level is the one that ultimately controls the situation. So the parasite does control the situation if it wants to be bad enough. And that's what we are in some sense. Like, we're not just a parasite. We're also everything else. But part of what we do can be the parasite. And that's what eats up the system from the inside. It's those people that get in there and they're corrupt and they know they can make a whole bunch of money by lying to people, and they can lie in a legal way. They know how to phrase it so that it's not illegal to say, but they know which way it'll influence people. So they want to say it to gain that influence. You just won't be able to prove that that's why they did it. That happens all the time. And that kind of stuff is the reason we have this craziness, because those people are making money and they're going up like this. Like, what do you think about FTX, right? So a bunch of people think it's a scam. And yeah, it definitely had elements of being a scam. But I also think they didn't think that any of this was going to happen. They were thinking, if the market continues to do what it does, I can borrow like this and it'll be fine. Because they're right. When things are like this, you can do that. It doesn't mean it's a good idea, because if things turn around, you end up in FTX's position. That's exactly what happened with everybody else. They bet too much during this time because all it was doing was going up, and they made a whole bunch of money doing it. So they got even braver, and they did it again and again and again. And eventually they got caught by so much that they didn't know how to react. They weren't able to react. If you scale into your position properly and you have nice low averages, if things come down, you're still up a bit. But if you're trying to ride the rails and take advantage of it like a lot of these people were, when it goes down, you're done. You're going to have fun on the way up, but that's it on the way down. If you're scaling in, this is an opportunity. This is a wonderful thing. Like, for my long account, I found that this was so like, I really did not like this in that year, because this is when I was getting really heavy into the long account versus the trading. Initially, I was all about trading, and I didn't really want to do anything with long investing because I thought it was a scam and everything else. But then I realized, no, that's actually the best way to make money, because if you just keep adding to good stuff, eventually the whole market pulls it up. And usually if it is good, it'll do well on its own. So finding the right companies, or finding an ETF with all the companies in it, and that's managed by the right people, can get you what you want. So I like the idea of either buying into somebody else's mutual fund or other type of fund, or buying into some sort of ETF, some sort of product that gives you long-term exposure to something and is hopefully managed by somebody else at a reasonable rate. Because you have to look at the management fees. Anytime you buy an ETF, you're also paying a little bit in management fees to own that. So you're going to make money in that, but it's whatever they're taking to manage that is going to be taken out of that. And whether or not you go up or down, they're still managing it, so it's like there are drawbacks to it. But at the same time, it's much safer than just having one stock that you like or a couple of stocks that you like, because they'll be in that ETF and there will be people that know more than you adjusting it and trading it and making sure it's afloat. Like, it's hard to run when you don't have anything to do and you get into trading, then that's great. You can do so much with it. But when you have a bunch of stuff to do, it's not as easy to follow all that. So you have to have different plans. You have to be able to look at it longer term and realize it's actually better because the stress is so much less. Yeah, you get hurt, but you can just turn it off and be like, all right, yeah, I know I'm supposed to be down. I'm looking at weeks, months, years. I'm not looking at minutes, hours, days, which a lot of people are. So it's much easier to do, and it hurts. But at this point, since I was going in on all this stuff, I'm up. I'm hoping that it continues. So if it continues to go down, I'm not going to be happy about that. However, if it continues to go down, my trades will start doing better, because every trend we have recently, my trades do a lot better. Like, we had these nice downtrends. I was doing well, and little pops, not so much. And there was one towards the end of the year that was a pretty bad one, and that was during this. I actually got hurt the most on the biggest pop. So what do you know? I have an inverse relate. Even though my main strategy is going long. That's the funny thing about this. I go long on a lot of my plays, and those are the ones that usually work out. Sometimes I go short, and those do work out, but I just don't like doing it because I don't feel as comfortable going short as I do going long. To me, it's easier to go long because it's easier to see where a company is going based on its momentum versus where some massive cataclysm could cause it to shift drastically. That could happen at any time, but trying to predict that is like, which direction does the massive cataclysm come from, and what is it? How does it affect your thing? I don't know, but just looking at the direction that it's going right now can tell you, all right, if things stay the way they are, it could be somewhere in here, and if I just buy a little bit of it, it'll profit me. That's what the long account gives you. When you have drops, when you have dips, when everybody's telling you it's the worst time to buy, that's when you buy. And if this continues to go down, I'm going to be buying again. Because I bought during this, and I took some profits. When we started getting up to this wall right here, and we were butting up against it actually, let me switch this to the daily so we can get a better idea of how this works. Because right now we're in a congestion area, and we had so many days of just over here. We had this nice pump started right about the beginning of the year, maybe even a little bit before in some cases. I think there are a lot of companies started right here. That's why you start seeing this green action, because the good companies are being bought and the terrible companies are being dumped so fast at this point. This is where there were some companies that went down so quickly. I'd never seen companies drop so fast. Most stuff stayed kind of where it was, but there were a few things that just got annihilated at the end of the year. So money was really readjusting early. And then when the tax year changed and people with large positions that need to trade based on tax rules could finally change their position because they'd been in long enough to pay the right taxes. So you'll see when that move, it's not always like the very first trading day. Sometimes it's a week later, sometimes a few days later. In this case, it took a few days for things to even out, and then boom, we kind of took off. And we really, even though we had this down set of days right here, it was mostly up. And look at where we bounced off of. We bounced off of the high volume area. So we were down here. We kind of consolidated. That gave me a little bit of an idea that there is some support here. And if you go back on the chart, there is a little bit. If you're looking at smaller time frames, like I do sometimes, but also on the longer term time frames where I tend to favor, you'll see right here there's some congestion. So then it takes off after that. So I thought, all right, this is a risk point. There are a lot of people that are in on certain things right here. So we have a base position going, and people that are willing to buy more off of that base position with the FOMO that'll come in from them raising the prices. So as people that want the stock buy it and have the money to move it, it starts to drift up because fewer and fewer shares are available. Then the other people start to FOMO in on it, and you get this kind of congestion into a break of these support levels. So we broke through that, came back, tested it, and bounced hard. So we ran into this support level, or this resistance level. And once we'd been here for a few days, I thought, okay, we've had this massive rally. We haven't had a big drop. So at some point soon, we're bound to have this move. So it was a little bit slower than I was expecting, but it was the same exact thing. It had to drift down, which isn't surprising because a lot of these things are quick moves followed by drifts. See, this like slammed through these levels, and then it sort of like drifted down and stayed in place, Went really quick, and then it sped into a stop. Boom, right there. And now we had a point where we hit that point and bounced hard. This is a big bounce. I was looking at the end of the day on Friday. I had to let I made some new adjustment positions on these 2 days right here, or actually these two last red days right here. And I was up, so I thought, all right, I got to take at least something off the table. I meant to ride these things for a really long time, but I was up so much in such a small amount of time, I thought, all right, I need to jump out of this real quick. So I jumped out of some stuff that I'm probably going to regret jumping out of. But if we end up going back down to this level or below it, then I'm going to be glad I took at least some profit from that. But my thought is, it's so volatile, it's unlikely we're going to pass this anytime soon. We probably will at some point, but I can see this being heavy resistance if we get back. But what would be even worse for that is if we get to a lower point and come down. Lower highs are extremely bearish in the short term, and that can cause these moves to accelerate. So in this case, I was thinking we've had a downward drift. We had some big moves, but most of it was a drift, and we had a huge bounce because of that, showing you that there is a lot of support. These bounces, it's like, how much force do you have? We had a lot of people that wanted to buy in here, because if you look at the 2 days that this happened, there wasn't a ton of news. There was news. We had some economic data. Stuff happened, but it wasn't any different than a lot of the stuff that had been happening right here. So to me, this was a readjustment of a lot of things, of a lot of people, a lot of entities. So at this point, we've had such a massive move that I got a little scared. Even though we could keep going, I dumped a little bit of it just in case. And I still have a bunch to the upside. I'm trying to build a downside position, but I don't know exactly when or if we're going to get that downward move. So that's what's difficult. It's easy to plan the long-term or the midterm and long-term upward plays for me, because I kind of think that's where the market's going to go. I think it's going to go sideways and maybe a little bit up. Even if we have some down movement, we'll have these quick volatile resets that bring us back to some sort of a mean, and that kind of creates that sideways motion. Even though the sideways motion could be clearing itself at any time, you still see that momentum. We went from the down part of the cycle, now we're to the sideways part of the cycle. And the sideways part of the cycle could last a while. I don't think it's going to be over right away, because every Fed person that you talk to is talking about holding rates down and probably going up. And a few of them are starting to say, all right, now we're going to raise our targets even more, maybe. We'd been kind of at the same point for a while, and all of a sudden they're thinking like, we've had a couple of bad economic data readings in a row. Maybe we should up our numbers a bit, which I kind of expected them to do if something like that happened. And that's supposed to give the market some reaction. And so far, it really hasn't. I don't think it's fully saturated. If we get to the next meeting and the market is still a little bit too excitable, then I think they'll come out a little bit more hawkish than they were expecting to. Because right now, with data points being under the estimates, even though they're not terrible, because we're going down, and it's not like you go down in a straight line. You're going to go down in a jet. Like, look, everything, it just oscillates in all these different ways when it's going in some direction. So even though things are coming down, we were bound to have some rebounds because we're comparing it to this point last year. And if the point last year was a fluke, then you could have reactions in either direction, because like, oh, this is what it is based on last year. It's like, yeah, it's based on this last reading at that point, which there was some crazy thing that happened that isn't happening right now. So sometimes there's reactions that aren't justified because people think, oh, it's too far past whatever. No, it just might be the fact that this is a weird comparison. That doesn't always happen, but that's something to take into account when you're looking at how bad things are. So when I see economic data that is still kind of trending in the right direction, I mean, things are trending down. They're just not trending down quite as fast as they were a few months ago, because we hit this peak that was a really quick peak. When we went up to 9% inflation, we came down pretty quickly to the 7s. It didn't take that as long as people expected for that to happen. And I think that's what makes people think that it's going to be over quicker than it will be. And that was the other thing that the Fed presidents were talking about, was that it's going to be sustained for a while, and I don't think markets fully understand that. And I agree with them. I think they're right. I think people don't understand sustained anything. We're all about go, go, go in any direction. And when things hold us to a point, we have trouble accepting that. We don't pay attention to that point. We just pull harder or push harder to the direction we're going. So that keeps us motivated to go wherever we're going to go, regardless of what's actually coming in, which is why we have this behavior, which is why this kind of stuff happens. And taking that into account leads me to believe that it was not a bad idea to take some profits but still be in for a move, because there's a lot of force. It could keep going with this force. But at some point, because there's so much force, there's probably going to be some correction to that. And are we going to correct up here at the level, or are we coming back? I don't know. I don't have a prediction for that. I'm just kind of watching. My thought was I wanted to have more cash, so when things get really volatile and option prices go up, I can look into selling contracts that actually look good, or having cash. I like selling calls on stock that I own. I've been getting into selling puts lately. So that's probably what I should jump to now. So I've been making a few trades, and a lot of what I was doing was selling puts during crazy downward drops. So a great example, which is something you would not think you'd sell a put against, right, was Bed Bath & Beyond. So Bed Bath & Beyond, it's got some problems. I mean, it's had problems for years. I drew this line way back in the early days of trading. This might have, I don't know, like 2018, 2017, something like that. And then they had this pump because of the pandemic. They were able to get cash so that people weren't looking at this in the long term. It's like, yeah, this is why they pumped, because everybody pumped at this point. Everybody that had a problem solver. They had the Fed. So they came in with the Fed and said, hey, can I have some cash? And the Fed was like, yeah, sure, here you go. Free cash. And now they're off to the races. And look at this. Then we had the GameStop squeeze, AMC, all that stuff. All the meme stocks. Everybody's like, yeah, meme stocks. Meme stocks have been a thing for a while, but this is when the mainstream media kind of catches on to it and takes advantage of it. And that distorts everything. It distorted the whole market. I remember telling people, like, this is about where I started to have trouble trading. I was doing pretty well coming into that point with everything else, but then suddenly things really changed. Like the people that had entered the market and exited the market in the 2020 season, let's call it, had made a huge difference in how the market actually functions, because there were so many people buying calls. The average person wasn't buying a ton of calls. It took the average person a while to get to options because they had to make their way through stocks and crypto and all this other stuff and have trouble with it and then go like, oh, what is this? It seemed risky at first because of all the leverage behind it, but now I'm looking at it and thinking maybe it's the way I should go. So it's a way you kind of get into it. But at this point, people just learn about options right away. It's like, hey, you heard of stock? Well, check out options. It's a way to play stock with less risk and potentially more reward. Oh, great. But it's also a way to play the stock with more risk and less reward. It's the exact same thing if you know how to do it right. So you get this with a company. This is why you get that, because they were screwed here. Everybody knew Bed Bath & Beyond was done like a decade ago. Well, maybe not a decade ago. I don't know. But 5, 6, 7, 8 years ago, people knew that this company had a problem. And the only reason it bottomed was because it got a bunch of free cash. And then you had the meme stock traders. And once it became a meme stock, its fundamentals were completely ripped from it. It joined the everything else and went crazy and it caused people who were into the market at this point to think this is a stock, it's coming back. Like if you look back at the history and you see this right here, or even this, and you got into the market somewhere in here, this has been all up and you've missed out on it. You thought about it here. You thought about it there. Oh man, I missed it. I thought about it so much there. I thought, good thing I didn't get it. I thought about it again. No, I shouldn't get it. Man, I missed it. Oh, I missed it. Why did I miss it? So you get that with the whole thing, but they don't realize that this stock was already at this point. So now we're finally getting back to that point after all the people that were tricked into believing in this stock, especially that, I forgot the guy's name. Like, was it Ryan Cohen or something like that? The hedge fund guy bought a bunch of shares and then a few days later dumped them and caused I think that's what this pump was right here. This was like the Ryan Cohen pump, and now everybody hates him, and that's why they don't want to take his whatever company he just bought in. They don't want to like jump in with him, which I get it. I don't want to jump in with him either, but I kind of do actually. It's like you might get one of these for a little bit. Just jump in for a day, get out, jump for a couple days. But no, I don't touch that stuff because it's too much. So anyway, point is, getting back to it, we were finally coming back down to the level that we were actually at with this stock. And we hit a point where negativity was so high that it outpaced the decline of the stock. It's not going to die right away because this was a huge stock. There are a lot of people invested in this. Institutions that are still invested in this stock. And they know they're done, but they signed contracts that kept them in. Like there has to be enough time for all that stuff to wind itself down. And all the people that say it's going to zero, yeah, it probably is going to zero. Unless they get bought out by somebody. It's somebody that wants to deal with all that debt. Somebody might just to have the brand name, which I don't know. I don't think people really care that much about it. But if you have the money and it seems like the right move, somebody could. But if they don't, yeah, this thing's going to probably go to zero and then dump out. But look what happens along the way. We get the Ryan Cohen pump, if that's what that was. We get these pumps right here, like the beginning of the year. We get this pump right here. I was selling puts in here. I remember when this happened, and I thought, no, I want to finish this one. I want this one to be complete, complete profit on this one. And then it came back down, and I was like, oh man, I should have taken it. Which is funny because actually the prices stayed the same, and that's why I really like selling options as opposed to buying them, because you can have a movement to a point and then a return to the previous point, and the option will be worth way less. So the stock, if you buy it at 10, it goes up to 12 and it goes back to 10, then you're where you were and it's no big deal. You still have something that you can hold for a long term. But if you have an option, you go from 10 to 12 to 10. That option has less time on it now, so it has its intrinsic value, which is ticking away if it's out of the money. It has no intrinsic value really. It just has extrinsic value, or it has very little intrinsic value. So if you're just a little bit out of the money and everything comes back down, that premium that you had, the potential for the stock to go back has decreased, which is why the option is worth less, because traders see it as less likely that the stock will even go back to where it was when something like this happens, especially when it has the fundamentals of Bed Bath & Beyond. However, it's not going to go completely to zero right away. There's so much pressure. It's like you're trying to push down on something and squish it, but it's a heavy material. It's not something that you can squeeze easily. So as we will squeeze it out, it's just got to take time to let everything unwind the way it's supposed to, and then it'll either be at zero or somebody will buy it or they'll find some miracle. Those are the three options, right? It either goes out completely, it's either bought out, or some other random thing that we don't know about pops up and they save themselves, or at least extend their life. More likely extend their life. So this is what I thought they'd do. I thought it would get down real low in the ones, maybe the below $1 or something like that. And then there'll be some random thing that they put out that kind of pumps them for a while. Maybe they get some cash. And if they're able to get cash, that alone will raise the value of their stock, because their total value, their net asset value will have gone up because they actually have the cash sitting there. So that would move it back if they're able to do that. But people know, the banks aren't that dumb. They know that Bed Bath & Beyond is not somebody they want to be lending to unless there's some way they know they can get their money back, which right now people don't think they will. So anyway, my point is, I knew it was going to drop, not as fast as people thought. So when this pump happened, it was an opportunity to sell some options. So I saw the pump, I sold a couple of things, I got out quick, and then it dropped really quickly. And I kind of did it again. All right. Now that it's dropped so much, I'm going to sell a short-term put. So somewhere in this mess, I sold a couple of puts, kind of wishing I'd sold more because it was cheap. It was down into the twos. I was like trying to get below two. I think the strikes that I had were like somewhere around the $2.50, $2 strikes, because I picked them up when the stock was $4 or $5, and or not when it was $4 or $5. Like I was looking at them when it was $4 or $5, and when it came down and they went up, I sold them from there. And this little bounce right here just drained all their premium. So I got out of some of them I got out of some of them right here, and then it pumped right here, and I didn't get out of the rest. I had puts. I could have just dumped them all out, but it came back. They really weren't that much. It was about the same price. I think it went up by like $1. The difference between here and here was $1. I thought for sure that going up to 7 something and then coming back down would have increased the likelihood that it would go up because it went up so high. No, it squished that premium. So I got out at about the same, even in this downturn right here, I got out at about the same price as I could have gotten out right here. So that's why I like selling options. If you bought long options or you bought puts or whatever it was, you got crushed as this thing came right back to where it was. So I was in there just loving that part. Got out of that and didn't really get back into it because the options are so cheap now. It's hard to sell puts without using a huge amount of money and taking a bunch of risk that I don't want to take. Because being a company that's this low, they could drop even quicker. It's like, yes, it is like a material that you have to compress and it's going to take a while, but they also will they could still take a shot like anything else. If something really big comes in and breaks it down, yeah, that could happen. And a company that's in this much trouble could definitely have that. And even it could happen if people don't even think it's actually going to happen, but they just want to start the rumor of it. That can happen too. Like companies like this are I could say victim, but it's just part of what happens when you've mismanaged your money for so long and you end up in a situation like this. Your stock is traded like crazy, and people can just use narratives and move it. And not even just you, it's other people. It's like, what news stories do these institutions want to pick up? All the people that are looking at these stories are thinking, what's popular, what's not popular, and they're going with what's popular so that they get clicks and stuff. And that can cause all these stories to make things pump like they shouldn't. So when I see stuff like that, I'm not surprised. And when it was up at 7, I knew that it was crashing down. I thought, this is done, dude. I was looking at selling calls because it was so obvious that these things were going to be worthless. But it was difficult. I have to use a spread. See, that's why I don't like selling calls that I don't have the stock for, because I have to use a spread to protect myself from infinite losses. And that spread eats all your profit away. It's so hard to find good profit, or at least the right risk to reward ratio, when you're using a spread. So I didn't sell any calls. If I had enough money and had a margin account, then I would have actually probably like sold some naked calls on this thing because it was so obvious. I remember looking at it at 7. It went up there in one day. I'm like, this was like $2 yesterday and it's 7 right now. And there's no news that's anything good about it. It's just pumping up end of day like crazy all of a sudden because it's a falling stock, because there's people repositioning, all this stuff is happening. So I don't think it's going to continue to go. So I'm looking at calls all day, getting mad that I can't find anything with the right risk reward ratio, and it went away. And I could have made some money on those, but it would have been so little that it wasn't worth it. I could do other stuff with that money, so I just didn't do it. So I sold puts at the right time. This pump offered, because it was a multi-week pump, or this day, it was a multi-day pump, and it stayed up at that point above VWAP. Like I was talking about earlier, VWAP is important on the longer time frames. And I thought this is a good chance, if it goes below that, to start selling some puts. So getting those puts in there during this time, and even I think maybe during this one, it was nice to have that point because it was actually the lowest point in this little mini trend. And then the premium drying up at the right time, getting out of it, that was great. If going long on this, I would have been completely out in either direction. Even though there were big moves, trying to go long on this and time this, you wouldn't have gotten that. Right? It had been dropping for a long time for good reason. These pumps are unpredictable. And yeah, you can make money on them. There are people that did, but it's just not worth trying to chase them if you don't know what you're doing, like me. I have no idea what I'm doing with those things, so I just don't touch them. So what I was looking at after that was also dumping some of my long plays. So I dumped some Tesla, right? I bought Tesla when it was way low. Everyone was hating on Tesla so much, which was great because that finally gave me an opportunity to buy in. So I missed out, man. I thought about buying it back here in the 200s and it just took off. Pre-split 200s, that was too much for me. Didn't want to do it. Well, now I wish even if I just bought one share, it would have been worth a good amount of money. So anyway, I was buying some Tesla in this mess. It got down to like 100. I might have even dipped below 100 at one point. I don't know. But it was close to getting to below 100. But after this huge drop, man, I was buying through like this bottom section right here. I think I started buying at this dip or one of these dips and catching a bit of a bounce. And sort of, actually, I didn't touch it at that point because it came back down. I thought, man, I should have shaved at that point because it was bouncing off of VWAP. It was under heavy stress. Everyone hates it right now. This is all the Twitter thing, really. Like the Twitter thing is what caused it, because most of what people get into for a stock, like any of these, is either the technical thing or the belief in the idea. And Elon Musk is a powerful figure in the media, so he had this big following based on it. And once that following was fractured, we had this big change in the way people viewed Tesla. So Tesla had nothing to do with it, but it kind of did because it took up his time. It meant he was going to be more stressed. And the more that Twitter looked bad, the worse people thought the stress was going to be because they thought he couldn't handle it or something like that, which, like, who knows? I mean, the guy does so many crazy things. I have no idea. But at the same time, it caused this volatility that some people took advantage of, some people sold, some people shorted. But when it got way down here, because I only had a little bit right here, I remember buying in this and being like, oh, this is cool. It went up. I should have bought more. But I just don't feel comfortable because I feel like it's going to keep dropping. And sure enough, it did. So I was glad I didn't. I was like that's why I say I just dipped my toe in at a point like this when things look really bad, probably somewhere. This was one of the ones that I got like right at the bottom, actually. I think this and Facebook, where their dips were, I remember getting right in there at that point thinking this is just so oversold. And that's why I like going up, because after seeing so many companies that I thought were done just bounce back at certain points, you kind of get a feeling for the area in which that could happen. So I was getting a feeling that there was going to be a short-term bounce around there. Ended up pretty much nailing it on both of those two because of the sentiment. That's what, for me, has to happen. There has to be negative enough sentiment on a good company in order for me to feel comfortable going long. That's why my long plays work out well in a down market, because I'm focused in on the ones that are actually worth trying to play instead of trying. Well, actually, I do hit everything else too. I do gamble like a degenerate with tiny amounts of money. It's fun to just take like $20 and throw it at something once in a while, and not just base your entire portfolio on this strategy or whatever. It's like I also want to have a little bit of money over here to just kind of be like, oh, that looks fun. I think I'll buy like a couple of calls, a couple of really cheap out of the money calls just in case. It's good to do that once in a while because there have been a few times where that's been really right. I think about, all right, how much money have I lost just putting, seriously, I'm not even joking, like $20, $10, maybe 30 or 40 at the most into a little random thing that actually looks kind of good once in a while. Those are what I call my lottery tickets. As long as I can have some of those once in a while, then and I'm good, because you got to have at least a little bit of fun with it. You just don't want it to make it your main thing. There are a lot of people that actually really do gamble hard on this and get burned. So if you could just take care of that, like, number one, by being busy, That's a great way to, if you're sitting there looking at a screen all day, you're going to make mistakes. But if you have shit to do, you'll forget about it and then be like, oh crap, I have a position on, and go look at it and be like, good thing I didn't check it. I would have gotten out with all that because I'm up now, but 20 minutes ago or 2 hours ago or 2 days ago, I would have been completely screwed. So yeah, it's good if you believe in something long term. It's good to just kind of let it go sometimes. That can be beautiful, but it can also make you miss out on things. So you start getting, you find a balance. You got to check it, but you just don't go really hard on checking it every day. So anyway, with Tesla, I caught that balance. I thought this is a great starter position. I want this to go down and pass my average, or I only had one buy at that point, so it wasn't even an average yet, but past my my initial position. And sure enough, it did. So I let it kind of drift for a while. And then when it got to this point where I think there was like a really big candle somewhere, this one or this one, I thought, all right, it's time to start getting into this. So I was buying. And this little bounce told me, all right, maybe it's time to chill a little bit. And it came back down. I thought, oh, I should have dumped, blah, blah, blah. But no, it popped. And then once it started getting up into this mess, I thought, all right, time to get rid of that. So I basically eliminated Tesla. I still had Tesla at this point. I had just a tiny fraction of it. And then when we got to the last couple of weeks, I needed some cash to make some plays. So I ended up liquidating Tesla. I ended up liquidating Facebook, because that was one of my best trades of the year right there. Meta. That was great. I loved it because it was just constant arguments about why Meta isn't as bad as people think in this downturn right here. And it was the same thing with Tesla. Like, I didn't argue about Tesla that much because it got way too political. So I was like, all right, I'm just going to not talk to people about Tesla very much. But Meta was great because there's so much business use for it. And there is with Tesla too, but more so with Meta. So when it was just going down, this drop right here piqued my interest, and I just started watching it. And they had a couple of really bad days in here, but this drop right here, this is what made me really get into it. I thought, okay, I after this drop, this decline right here, I wanted to dip my toe in. So I dipped my toe in somewhere in this mess because I remember being down a little bit on that initial position too. But that gap down made me so happy. That was when people were the most bearish on it right there, when this thing happened. And they're telling me how wrong I was. I thought, I am just starting my position. I have a tiny, tiny fraction of what I actually want in this stock. So I'm going to build it up. And during this downtrend right here, it didn't last very long. I was going heavy in this thing. Like, each couple of days that it was down, I was like, oh, I got to get some more. It got to a point where I was like, all right, I don't know if I really want to get any more of this. It's getting a little scary. Like, how much of this account do I actually want to put into this thing versus do anything else with? So I kind of slowed it down a little bit when I I was good. I'm glad I didn't speed it up. Yeah, of course, looking at where we are, I wish I had sped it up to infinity. Hindsight is 2020. But at the time, I played that perfectly. I'm so glad that I played it the way I did. When I just put a little bet in there, seeing this go up, a lot of people would just go in more. But because I was looking at how it was performing, what people thought about it, sentiment was so low. This is what started the whole thing. I mean, this gap down just ruins. Like, when you see a gap down like that, that hurts people. And a gap down followed by a downtrend and another gap down, that's horrifying. That's like life-ending stuff right there. People get out of these stocks forever when they get to those points. So that's why I liked it as a turnaround, because I thought, this has been murdered so bad. I have to be able to get something in this thing. And sure enough, I did. So it pumped. It came back up to here quickly, and it sort of sat there, and I thought, yeah, that sounds about right. It's not dropping is the important thing. It came back up. It was floating pretty well, and it's been going up ever since, because it had a huge reaction to the fact that people didn't have legs in the metaverse. Big deal. Yeah, I know there was other stuff going on, but that was really a big portion of it, because that was what was in people's psyche. It wasn't the numbers. Yeah, they were sinking a bunch of money into it, and then people were thinking about that, but all you ever heard was, oh, the legs, oh, people were being harassed in there, oh, this and that. Like, you were just hearing about one piece of one of their products and applying that to the entire thing. That will oversell a company, which is why I knew this was going to happen. I mean, you could be wrong at any time. I mean, any company could be done, and that space isn't theirs anymore, yes, but they just have the most momentum. They have more than 3 billion plus users. It's probably more than that now, but they're basically in most of the planet. This Facebook and all these companies have access to most of the planet in some way. So it's not like they're just going to go away, right? It's very difficult for a company that's doing that well, number one, has that good of a balance sheet, or at least did before they went heavy into this metaverse thing. They still don't have a bad balance sheet compared to most businesses. They have one of the better ones. Like, before all this stuff happened and they were just sitting on piles of cash, I remember thinking, man, I wish I bought Facebook years ago. It was such a good buy. Facebook was so undervalued when it came out, because it was the old guard versus the new. That's how it happens all the time. And they just didn't believe in it because it was a different thing. It was a threat to everything else that had been going on. But really, it was just an extension of that. It was the same thing in a different realm. Just like what we're doing with streaming. Streaming is the television of today. Television is the radio of the previous year. Radio is the print of the previous. It's just, it takes a step up each time and it becomes the next thing. And that's what we have with Facebook. It is the next thing in line. And now we're at that point. It's not that Facebook is up and coming the way it was when it was first released. It's that it is saturated now, and while it's still growing, it's not growing at anywhere near the rate that it did before, so it has to do other things to make money. And that's why it's going heavy into this metaverse thing, because the metaverse thing could be as big of a shift, if not a bigger shift, than the social media revolution was for them. Because, like I said, you can sit at home and do everything. People that were going to like a Matrix style lifestyle at some point where there will literally be people just sitting in a pod in their house that has all the temperature and everything they need to survive and food coming in whenever they want it. And it's just, they can just control everything with their mind. We're literally heading towards that kind of a thing that's possible. Is it going to be all sci-fi and crazy like we think? Maybe, maybe not. Maybe it'll be boring. Maybe it'll be like a bunch of people don't actually do it and a bunch of people do. And then you just have this mix of like, all right, the people that don't do it just kind of take care of things. And the people that do it have access to the tools that can provide. Thoughts beyond our thoughts. The ability to find information faster than we can right now. So think about like how much quicker your day would go if everything was instantaneous. We say everything's instantaneous, but it's not really instantaneous. It's quick compared to what it used to be. It's a light year. It's light years ahead of what it used to be. But we could be looking at something that's light years ahead of this, and we don't know how that's going to react. Our ability to predict the future gets worse and worse as time goes out, which is why we have these extending graphs outwards that say it could be a wider and wider range of possibilities. That's what standard deviations basically have. But with Facebook tying all this back, there was an overreaction to such a move where the belief in the company led people to dump this thing radically, and it didn't get above VWAP at all. Well, I mean, not at all. It didn't get above VWAP very often at all, I should say, because right here this was a nice squeeze, but it hit its wall and went back under it. Has these little pokes above it, but it gets rejected right back down below it. And then you look at the other side. It starts to flip. It's not done yet, but it starts to flip. It's sitting on top of it. It's telling you sentiment is pointing upwards, which is why when this happened, I was comfortable writing it. Because I thought, let's see how people adjust to it in the new year. It started in the 300s. It ended in the low 100s. That's a huge jump for institutional investors that wanted to get in on this thing and watched it just go up for years. That's a great opportunity. So I said, let's see what people do with that, which is why I was in as heavily as I was at this point. And then when we had this and this big pump, oh, this was amazing. I mean, throughout all of this, I think I was waiting till about here. They had earnings coming up. I thought, I'll take a tiny, tiny bit off the table. But then we had this massive jump, and I thought, I should have kept that. But good thing I didn't dump more, because I thought the earnings were a chance for it to maybe start having a little bit more difficulty before something like that happens. So after this pump, I thought, oh, this is amazing. I have to take a bunch of this off the table. So I took a good amount of it off the table, but I was always keeping some because I want to go long in it long term. But then we had some stuff go on in the last couple of weeks, and I ended up dumping that too. So I took my profit on everything from the Facebook, everything from the Tesla. I may regret that later if it keeps going up, but I needed to do other things, and I feel like volatility is still high enough to where I don't think we're going to see Facebook or any of these companies go back to these highs anytime soon. I do think they can get back there, and I think it's likely that they will because of many factors, but I don't know how quickly. So I want to make sure that I'm not rushing into this thing and getting myself caught in a bull trap if we continue to go down. And I also don't want to get rid of everything completely, which is why I didn't like that. But with the whole market doing this exact same thing and running into a wall, I wanted to get rid of that. So I got rid of those positions. I had some long positions that when they came up for some profit, like I had some Virgin Galactic calls that I bought a while ago. I bought some leaps in it because so far Virgin Galactic's actually been a decent stock to trade as far as the options go. And even better with the shares, actually, because it moves so much, so easily, and it's a stock that just continues. When it goes down really low, like when it was in the threes, I bought a bunch of calls on it because I thought, all right, this is looking really good. And that hurt for a while because, man, it was down there for a bit, but it paid off quickly. You know, the thing bounced up to the 4, 5, 6, and then I was like, all right, let me dump some of these out. So I dumped them out, and then I decided, I want to go with some shares and sell some more calls. So I did that for a little bit and sold some calls on them, and I was all right, but the premium on the calls had dropped because it didn't go past a certain point quickly enough. So it was like, all right, well, that would have been good if I had been able to sell calls before, but now premium is drying up. So I think I'm going to dump those shares and kind of move it into something else. So I ended up letting those shares go as well in order to go into cash. So what my trading account Actually, both of my trading accounts are mostly in cash. I have a few long plays. I've got my 23andMe plays going on that I've had for a while now, and they've been at the same price for so long. It's been nice. It's so cheap for these contracts. It's like $15 for the cheap ones, $10 for the cheap ones. It's 30 or 40 for the really expensive ones. So it's at a point where it just doesn't go down that much. And when it does, those contracts don't drop that much because long-term contracts that are that close to the money are still extremely valuable. So just having cheap options is nice. So I have those, and I'm going to hold those even if they go to nothing, because if this thing pumps, anytime the market moves enough, this thing floats up with it. And after a certain point, those options start moving. But right now, they basically, even when we go up, they just kind of sit where they are. So it's not an easy thing to hold, but having a little bit of it continuously has been nice. So I didn't get rid of any of that. I've just been building up that position. The farther out in time we go, the more I grab some of those, because I feel like at some point it's the perfect stock to get a pump at some point. Right? It's just within the reach of the meme and the mainstream, just enough, and it's cheap enough. It has options that are cheap enough that it's a nice long-term kind of swing trade play. So I kept those. I got massacred on my Snapchat and my Canopy Growths, because I had Canopy Growths for so long, and I had opportunities to sell them last year when you had those little pumps, but I didn't take them because I was looking for something else that I never got. So I got just massacred on those. I don't have a lot of those left. I've been kind of selling them off and rolling some of them up closer to the money rolling them out in time as time goes by, so I can continue these plays, but just in a lower sense, because I already have the ETFs. I don't need. I was liking Canopy Growth because I thought if we had a pump in the weed sector, they're one of the likely candidates to take off. You know, them, Tilray, all these ones, like the big names, despite how good they are, they pump when the cannabis is hot. So I took advantage of them, and I didn't take the gains when I should have, and ended up paying for that. So that was one of my disappointments from last year. So I cleaned up that a little bit. Snapchat was the same thing. I made a ton of money at the beginning of the year on Snapchat when they had that massive move on their earnings. And then after that, I tried to hit them again, but they've just been, every single earnings they have, there's something that keeps them going down. And the thing with Snapchat is they had these nice pumps either direction, really far sometimes. So it's nice to. It was something that I was okay spending a little bit of money on, but I kept it dialed back a little bit because of all the pain that I'd felt in the cannabis sector plays. So I thought, all right, this one's kind of, it's not in the same vein, but it is sort of in that sort of direction. It's kind of an iffy stock, right? There's like the stocks that are stocks, and then they're the ones that people look at it like, because Snapchat's kind of weird to some people. So it's like this sort of off-putting stock. So that's why it moves a lot when things happen, which is why I was like, all right, I caught calls on this thing so many times. I'm gonna try again, because it's been beaten up so much that it's got a chance to at least go up a little bit. Well, it got beaten up a lot more after that. So that one was not cool too. So I kind of downsized those plays as well. I still have some, but not as much. You know, at this point, it's like I've lost so much in those plays that I'm just going to let it go. I'm not even going to try. I took some of my money out. I reduced the size of these positions to the point where I don't care about them anymore, and I can just let them go into oblivion if I want to. So I did that, but I mostly went into cash, and one of my accounts is pretty much completely in cash, and the other one, there are a few plays going on. My long account, I've just been adding to, and I will continue to over time. Whether the market's up, whether it's down, I add to that one. That's the difference. I have the one account that follows the market no matter what, and then I have two other accounts that kind of do up, down, left, right, whatever. You know, so I was trying to sell some options. I took some long positions. I got rid of those. I had a couple of little missteps with some stupid gambling plays, but didn't lose much on those. The Qs, that's what it was. I got eaten up on the Qs a couple weeks ago because we were having this nice downtrend, and I wanted to take advantage of it, and I hit it at the bottom. So that was too bad. It bounced, and then, you know, of course, after I get out, it kind of drifts down a little bit. But the funny thing was, those contracts really didn't change. So I got out at the right time. Actually, well, not the right time, but I noticed it was time to get out, and I was right, because those contracts kept devaluing themselves even as the stock kind of went in the direction I thought it would. If you don't get your move quickly enough, you just got to leave. You got to get out of those things, and that sucks sometimes because sometimes it comes back. But the problem is, if you sit for too long in those things, they just die. That's the whole point of options. They're hot when things are moving, and then they die quick when they're not. So you have to be able to buy when they're not moving and just dump them when they are. And you're going to miss out on gains doing that, but that's the only way I've been able to play long options. Like, playing short options is the way to go. That's why I told you about the Bed Bath & Beyond thing. It was nice to have some cash covered puts, so I didn't have to do a spread. I hate spreads. They eat into your profits, and you get into them and you wait and you wait and you wait, and it doesn't go down. And then one day, like, the stock moves in the other direction, and you're like, dude, if I had this naked, I would have had so much money right now. But because I had a spread, they ate into each other just enough to where it's a wash. So being able to do some cash covered puts when premiums were way elevated for Bed Bath & Beyond and Virgin Galactic and stuff like that. So, and that was right, Beyond Meat. So I did the same thing. I sold puts on Beyond Meat during its little jump after earnings. I let it do its thing on earnings and was able to get in at a good spot. And then, no, actually, it was before earnings. That's right. It was coming up to earnings. So a few days beforehand, I got out of it at the right time. And then when after earnings, I kind of hit it again. So it was nice to play those stocks. Those were the good ones for me lately. And it's so much better to do it without spreads. That's why I was looking for cheaper stocks so that I could take the amount of risk that I want. The problem with more expensive stocks is the strike prices have greater distance between them, so you have to risk more money to do a spread or risk more money to sell them outright. So it's nice to have a stock that I could actually do that. And if I add a couple of contracts or whatever, it's not a huge difference in cash, where if you add a couple of contracts of something like Home Depot, that adds up quick, or something like Tesla, that adds up quick. So that's why I was looking at those stocks, and they had so much hate against them. They're not all good stocks. Like Bed Bath & Beyond is terrible. It's not a good one. Beyond Meat, that one's it's neutral to me. It's not that. I think the prospects aren't very good because it's not like nobody was doing that before they showed up. They try to act like that's the case, but that's not the case. It's everybody. So many companies, big companies, were already making vegetarian options like that and vegan options decades before Beyond Meat. So they're getting into an industry that isn't new. They're trying to break into an established industry. So I think they have they have a lot against them. They just don't have the power of the other of the juggernauts. But the trends do show that there's going to be demand for it, and then there's going to be waning demand for it. And it's going to kind of go back and forth because it comes up as a trend every now and again. It has merit behind it, even though people abuse it, that there's a reason for it to spread, and it kind of does sometimes. So Beyond Meat, I think, has potential, but it also has a lot of competition. So there's a lot more to it than that. But my basic thesis with this was that it had been sold off for a while. It has a little bit of news pumping it up for a bit, and we have the market, more importantly, that's in the condition that will allow it to do what it does. So all of those were nice little moves on there. As far as the market, I haven't really done much, except I tried to short it and missed out on it. Not missed out, I got crushed by it. So really, I've just been in individual stocks. I think that's the best way to go right now, is look for individual stocks that and trade them the way that works best for you. And just wait if you have to. Don't try to get in on anything. Like, wait for those opportunities that present themselves. Like Bed Bath was perfect. Everybody hated it. It was because the premiums were high. That was the main reason I did it. I was looking at the premiums and I was just like, wow, they're really, really pumping this up for this like $3, $2.50, $2 area. Even below that, people are thinking that it's going to go to 50 cents in a week. No. So in 2 weeks, that's what it was. It was 2 and 3 week contracts. I was looking at those and I was just like, these are great right now, because it's highly unlikely that it's going to be at that point in the next few days, but the premium will just get absolutely killed during that time because it's so elevated right now and it's so close to expiration. So that was everything aligned perfectly to take that trade. But if I'd been trying to force it, like later on, I was looking to do it again because it worked. When something works, you look for it again. So I was looking for it again, and I almost did it a couple of times, and I thought, no, this is just not the same risk to reward. The premium has been sucked out of these things, and I just can't. I have to risk too much money to make too little. So I just didn't do it. And I mean, I could have made a little more, but it's continuing to go, and it's volatile, so it's not worth that much risk. So anyway, that's what I've been working on. The numbers lately in the economic field, getting to that, have come out outside of estimates. Before, we were beating estimates. It was always better than expected, but finally we've had a couple of readings that were technically worse than expected, but still in the right direction. It's saying that things are cooling off. They're starting to slow down. They're not moving as quickly as they were because we're comparing to a different point, but it's still heading in that direction because the Fed has applied pressure, and that pressure is continuing to hold us in the same spot, which is hurting the companies that need the economy to be moving to stay afloat. So the longer they hold this, the more they squeeze them out. And they're trying to do that without hurting. They're trying to cut out the bad tissue without hurting the healthy tissue. But I don't necessarily know if they're going to be able to do that. So if they're going to be able to do that without too much damage to the economy, because there's going to be some. I don't think they're going to do as much damage as a lot of people think. I think they actually are able to do somewhat of a soft landing, as they've been calling it. But I also think that there's a good chance that we push things a little bit too far if the readings don't come down the way they want. Because what they've been saying the whole time is we're going to do it based on the data. But what a lot of people don't focus on is they kind of said after that, they hinted after that, if the data doesn't show improvement, we're just going to keep going. People don't know how bad that could be if they just keep tightening the lever. If they get desperate and they just keep tightening, and not just in interest rates, but everything else, eventually they'll hit a point where they'll start hurting the big companies that are holding everything up. They'll start hurting the people they don't want to hurt. And that could cause some serious pain for the rest of us. I mean, that could collapse the entire economy. But I have a feeling it's not going to get to that point. I think we're going to have some strain. I think we're going to have some good companies go. I think that's inevitable. There are going to be jobs lost. There's no way unemployment is going to stay where it is if rates continue to tighten and then hold that level for a while. That's just not realistic. There should be some movement. It's possible that there couldn't be, but that's so unlikely that I think it's not going to happen. I'm basically not planning for that. Well, that's not true. I try to plan for every possible scenario, but I'm not expecting that as much as I'm expecting everything else. So I can see them causing some damage to the economy, but then bowing to political pressure to back off. That's the other danger. Will they back off too early if this doesn't go their way, or if it doesn't go their way and they're crushing the economy? So that's the balance that they're going to have. But right now, they're going to be more heavy-handed than not. They're more likely to lean to the hawkish side if they need to. It's like Bullard, he was saying, I want to get these rates in now. He's been saying, I'd rather have it done early than have to drag this thing out for the entire thing. So Bullard is fine with slamming rates up a lot. And it's not just him. So many other people are saying the same sort of thing. And Powell was saying you got to be data dependent. He doesn't think it's going to be as bad as people think, but there's still the worry that it could be, and he's willing to do what it takes. He's willing to hurt us. That's what they're saying. Bullard, I'm willing to hurt you. Powell, I'm willing to hurt you. Brainerd, willing to hurt you. Kashkari, willing to hurt you. Waller, willing to hurt you. Bostic, willing to hurt you. They're all saying the same thing. They don't want to hurt anybody. I'm not saying that they are, but they're saying, hey, if we have to break a little bit of this economy in order to save the whole thing, we're willing to do it, which means somebody is going to have to suffer. So that's kind of an inevitability. And I would expect that if things don't clear up, they're just going to jam it until something happens. They're just going to raise rates until something bad happens and it all falls apart. So, well, not really all falls apart, but you know what I'm saying. Like we have a problem. So right now they're going to be more aggressive than not. So I'm expecting things to look like they might be worse than they are in the future. So projections, that's what I'm saying. I'm thinking projections are going to start to match that sentiment at some point. Basically, last year's philosophy is still kind of working its way out of the system. We're moving to the next phase, which is the holding phase once they get to that point in rates. Even though they're talking about continuing, their focus now is on how long do we hold? What do we hold it at? How do we determine whether or not we should adjust with the data? So they're looking at the next step. Right now, we've done the drop. Now we're looking at the sustain. That's what the Fed's basically saying with a lot of this. Even though we could still have a drop, they're expecting it to kind of sustain. And usually it does what the Fed says it's going to do. Not all the time, obviously, with the whole transitory inflation. But that's all people ever focus on. They give them, there's like some things the Fed does and they're wrong. And that everybody points to that all the time. It's like, yes, I know they made those mistakes. Duh. I agree with you. It's dumb. But at the same time, have you noticed that like 80% of the time what they say happens? Do you think that's by accident? They can't have it happen all the time. And even if they were really truly in control of everything as much as people think they are, there would still be issues having that full, having full control, having full everything over it. There would be problems, right? There's too many moving parts to actually pull something like that off perfectly all the time without any hiccups. So there'd be hiccups here and there. Anyway, the point is the Fed has control of the money supply, whether it's good, whether it's bad, whether it's neutral. It's probably an institution to listen to as far as what they think might happen. Because are they going to crash it? Are they going to crash their own thing? No. they're gonna keep it going because they want it to keep going. So if bad things are gonna happen, they're not gonna completely stop them because number one, you can't stop all of it, and number two, if you try to manipulate things, other countries aren't gonna want to do business with you, and they're gonna start migrating away from your trading platform, which is the dollar. The U.S. has interests in keeping people trading with it. As much as they have interests in exploiting the system just like everybody else, they also have an interest in making sure the game is fair enough that people keep playing with them. And the fact that people continue to shows that they're actually doing that. Regardless of what your opinion is, they're playing nice enough or they're playing just fair enough to keep the game going. However rigged they are able to have it, I don't know. I'm not going to get into that. But I do know that there's just things beyond people's control. And it's difficult to get past those things by yourself, and sometimes even in a group. But if you're isolated and you're trying to control everything, it's just not as easy as letting things play out and just making the manipulations here and there when you need to, or when you're actually able to. And instead of manipulations, maybe it's taking advantage of something that's good for you or good for other people, and that's it. Maybe it's not manipulation. I don't know. Anyway, I'm rambling about all this stuff. I need to kind of wind this down, but I had a couple of good trades there, had a couple of stupid little gamble ones, but all in all, pretty good. It was a rough ending to last year because I got hit with that loss on the Fed, and then I kind of kept my plays to a minimum. And then a lot of the stuff that I was buying hadn't paid off at that point that much, so it was rough to hold it. But seeing all this and finally being able to take advantage of that was great. It was too bad I was gone and wasn't able to pay as much attention to the markets because I had a bunch of personal stuff going on. So, I mean, that was rough too. But it was good to get up to here and then take some profits and kind of sit on the sidelines a little bit while still having my skin in the game too. It's not just about making trades. It's also about the long positions and the short positions and everything. So I hope everybody's been doing well. I'm going to get out here. Thanks for hanging out with me. I appreciate you coming in. It's been an interesting week, or it's been an interesting couple of months, and it's going to be an interesting year. So stay safe, and I'll talk to you later.